This is the simplest explanation of a max-funded, properly structured indexed universal life policy. Properly structured means the least amount of insurance with the most amount of cash growth. 95% of policies are not structured correctly, so be careful. Universal life is just an insurance contract, kind of like a renewable term. You pay premiums and you get insurance or death benefit. Indexed universal life, if you pay a little bit more than the minimum premium, you get some cash value. That cash value is then indexed to a fund. Key note here, it is not in the fund. Because the contract is insurance and not considered an investment, it is able to grow tax-free. You're also able to access that money tax-free. It transfers tax-free when you die, and you have protection from market losses. Protection from market losses, how does that work? That's because you have floors and caps. Let's say you have a floor of 0%. If the market goes down, say -5%, you hit your floor of 0%. So you lose nothing due to market downturns. Nice. The caps are the opposite. Let's say you have a cap of 10% and the index fund does 12%. You only get 10. Here's a quick 5-year example of an indexed return versus an IUL return. As you can see, the first year was 10, so the IUL did 10. The second year was 20, we hit our cap of 10, so we did 10. The third year they lost 15, so we hit our floor of 0, we did 0. The fourth year they did 3%, so we were in between our floor and cap, so we did 3%. The fifth year they lost 2%, so we did 0 because we hit our floor. And it was tax-free. Access tax-free, how does that work? First is withdrawals. You can only withdraw up to your contributions tax-free, taxed first in, first out. You may also take loans. There's 2 different types of loans. One are fixed or zero wash loans. They're not available in early years all the time though. The second is variable or index loans. You get a variable rate capping at, let's say, 5%, and the market grows 10 while your money is still indexed, so you get the full 10% minus the 5 you pay, so you gain 5%. Doesn't always work that beautifully, but just an example. Well, how does it transfer tax-free? Okay, let's say you had a cash value of $500,000 and a death benefit of $550,000, and you die. Well, $550,000 passes to the beneficiary tax-free because it's considered an insurance and not an investment. You do not get $1,050,000, you just get the $550,000 because you're only paying for $50,000 of insurance. And that's IUL when it's properly structured and maximum funded. Be careful, 95% of policies are not structured this way. Beware. Ask questions below.